Welcome to the deep dive. Today we're going to be talking about Greg Gliner's book, Global Macro Trading, Profiting in a New World Economy.
Sounds interesting.
Yeah, it really is. Instead of picking individual stocks, we're going to zoom out and look at big picture economic trends.
You mean like currencies and interest rates and commodities.
Exactly. It's about understanding how all those things connect and impact global markets.
So instead of focusing on one company, we're trying to understand the forces that drive entire economies.
Right, and that's what makes global macro trading so intriguing, because you're looking at the big picture.
And it can be pretty profitable too, right?
Oh, absolutely. In fact, Gliner points out that the Barclays Global Macro Index averaged a 10% annual return from 2002 to 2012.
Wow, 10%. That's pretty impressive.
It is, especially compared to the S&P 500, which only averaged 2% over the same period.
So there's definitely potential for big gains in global macro trading.
There is. But it's not just about picking the right assets. It's also about understanding the psychology of trading.
Ah, yes, the mental game. That's often overlooked, isn't it?
It is. Gliner actually dedicates a whole chapter to this topic.
Really? What kind of things does he talk about?
Well, he emphasizes the importance of having a structured process to minimize the impact of biases.
I see.
Yeah, like framing, for example, where the way information is presented can influence our choices.
Oh, I see. So, like, if a trade is framed as a guaranteed winner, we might be more likely to take on excessive risk.
Exactly. And then there's anchoring, where we fixate on a specific piece of information and maybe overlook other crucial factors.
So how do we avoid falling into those traps?
Well, Gliner recommends keeping a detailed trading journal.
A trading journal, how would that help?
It helps you track your reasoning behind each trade and then the results, so you can start to spot patterns in your decision making.
Ah, so it helps you become more aware of your own biases.
Right. And it also helps you assess the risk and reward of each trade before your emotions get involved.
And speaking of risk and reward, Gliner suggests aiming for at least a 1.3 risk to reward ratio on every trade.
Wait, a 1.3 ratio. So for every dollar risked, I should aim to make 3.
Ideally, yes, because trading involves uncertainty.
So you're saying I should aim for bigger wins to offset potential losses.
Exactly. You're not always going to be right, so your winning trades need to compensate for the losing ones.
Makes sense. It's all about the long game, not just trying to win every single trade.
And that's where the Sharpe ratio comes in, which measures risk-adjusted returns.
The Sharpe ratio, that sounds a bit technical.
It's basically a way to evaluate the efficiency of your trading strategy.
So a higher Sharpe ratio means I'm getting more return for the level of risk I'm taking.
Precisely. Now let's move on to the 4 core asset classes that global macro traders focus on: currencies, equities, fixed income, and commodities.
Okay, let's break those down one by one, starting with currencies.
Currencies, or foreign exchange, FX, are constantly fluctuating against each other.
And what drives those fluctuations?
Well, things like global trade, interest rates, and central bank policies can all have a big impact.
So it's a pretty complex market.
It is, but that's also what makes it so exciting. Now, how about equities? What comes to mind when you think about equities?
Well, I think of stocks, buying and selling shares of companies.
Exactly. And indices like the S&P 500 can give you a good sense of overall market sentiment and economic health.
Okay, so what about fixed income? I've always found that term a bit confusing.
Think of it this way. Fixed income is essentially about lending money and receiving interest payments.
Ah, okay, so it's like bonds.
Precisely. Government bonds, corporate bonds, they all fall under the umbrella of fixed income.
Got it. And last but not least, we have commodities.
Commodities are raw materials, things like oil, gold, agricultural products.
So things that are essential to our economy.
Exactly. And their prices are heavily influenced by supply and demand dynamics.
So global events like wars or natural disasters can really shake things up in the commodity market.
Absolutely. And here's the thing. All 4 of these asset classes are interconnected,
Meaning,
meaning that changes in one market can ripple through the others.
so a rise in oil prices could lead to higher inflation, which could then cause central banks to raise interest rates.
Exactly. And that could then impact currency values and stock prices.
Wow, it's like a giant domino effect.
It is. And that's why global macro trading is all about seeing those connections and anticipating those ripple effects.
But how do we even begin to make sense of all those moving parts? It seems pretty overwhelming.
Well, that's where technical analysis comes in.
Ah, the charts. I've always found those a bit intimidating.
I know. It can seem that way at first, but it's really just about learning to read the language of the markets.
So it's not about predicting the future, it's about identifying patterns and trends.
Exactly. And there are different types of charts, like line charts, bar charts, candlestick charts.
So each chart tells a different story.
In a way, yes. And then we have tools like moving averages, which help smooth out price data and identify trends more clearly.
So technical analysis gives us a way to visualize what the market is doing.
It does. And there are all sorts of interesting patterns that traders look for, like the head and shoulders pattern, for example.
That one actually looks like a head and shoulders, right?
It does.
Hmm.
And it often suggests a potential reversal in the current trend.
Fascinating. So technical analysis helps us make sense of all that data and identify potential trading opportunities.
It does. But before we dive deeper into specific markets, I'd love to hear your thoughts on currency trading. It's such a massive and dynamic market.
It is, and I have to admit, I find it a bit mysterious.
Well, the FX market is divided into four main liquidity pools, each with its own unique characteristics.
So it's not just one big homogeneous market.
Not at all. And traders use various strategies like forwards, swaps, and options, each with its own risk and reward profile.
So there's a lot to learn about currency trading.
There is, but it can be incredibly rewarding. Gliner actually points to the Hong Kong dollar as a really interesting example.
What's so special about the Hong Kong dollar?
Well, it's pegged to the US dollar, which means its value is tied to the US dollar.
Oh, wow. I didn't realize that.
It creates some unique trading opportunities and challenges. All right, moving on to equities. What are some key things traders need to know about this market?
Well, I know there are different types of indices, like the S&P 500, which tracks the performance of 500 large companies.
Right, and the S&P 500 is market cap weighted, meaning companies with larger market values have a greater influence on the index.
So a company like Apple would have a bigger impact than a smaller company.
Exactly. And speaking of valuation, how do traders actually determine the value of a stock or index?
That's a good question. I've heard of things like price-to-earnings ratio, but I'm not sure how they all work.
There are several different valuation techniques, and Gliner goes into detail on each one.
Like what?
Well, there's price-to-book ratio, price-to-earnings ratio, dividend yield.
So each ratio tells you something different about a company's financial health.
They do. And by comparing these ratios to historical averages or to similar companies, traders can get a sense of whether a stock is overvalued or undervalued.
All right, I think I'm starting to get it. Now, fixed income, that's the one I'm still a bit fuzzy on.
Fixed income revolves around understanding interest rates and debt.
So it's all about bonds and loans.
Essentially, yes. And for government bonds, knowing how to read yield curves is crucial.
Yield curves, what are those?
They show the relationship between bond yields and their time to maturity.
So a steep yield curve might indicate that investors expect interest rates to rise in the future.
You got it. And then there are complex instruments like credit default swaps, CDS.
I've heard of those. Weren't they a big factor in the 2008 financial crisis?
They were. Essentially, they're like insurance on debt, and they can be pretty risky.
Okay, last but not least, we have commodities.
This market is all about supply and demand dynamics.
So things like weather patterns and government policies can really impact commodity prices.
Absolutely. And OPEC, the organization of the petroleum exporting countries, has a huge influence on oil prices.
So if OPEC decides to cut production, oil prices are likely to go up.
Exactly. And that could have a ripple effect throughout the global economy.
This is so fascinating. I'm starting to see how all these markets are interconnected.
They are. It's like a giant web. And global macro trading is all about understanding those connections.
But with so much information to process, where do we even begin?
Well, one of the most important players to watch is central banks.
Ah, yes, the Fed, the European Central Bank, they have a lot of power, don't they?
They do. They set interest rates, manage currency reserves, and try to keep the economy stable.
Their decisions can really move the markets.
Absolutely. And understanding central bank policies is crucial for any global macro trader.
So it's like they're the conductors of the global economic orchestra.
I like that analogy. They set the tempo, and traders need to follow their lead.
But with so much data out there, how do we even keep track of it all?
Well, that's where economic data releases come in.
You mean like reports on GDP, inflation, and employment?
Exactly. Those releases can give us valuable insights into the health of the economy.
And they can trigger some big market moves, too.
They can. For example, a strong jobs report might boost both equities and a country's currency.
It's all connected, isn't it?
It is. And then there are indicators like purchasing managers' indices, PMIs.
I remember reading about those in Gliner's book. What makes them so special?
PMIs are leading indicators, meaning they can give us a glimpse into the future direction of the economy.
So they can help us anticipate potential market shifts.
Exactly. But even with all the data and analysis in the world, we can't forget about the human element.
You mean our emotions?
Yes, our emotions can often lead us to make irrational decisions, especially when money is on the line.
So how do we keep our emotions in check and avoid making costly mistakes?
Well, Gliner advocates for a systematic approach, using historical data to backtest our trading strategies.
So it's about learning from the past and avoiding repeating those same mistakes.
Precisely. And that brings us to another powerful concept, analogs.
Analogs, what are those?
An analog is basically a historical comparison, like finding a period in the past where the market behaved similarly to how it's behaving now.
So we can use history as a guide to navigate the present.
Exactly. Gliner gives an example comparing the U.S. dollar index's performance in 2007-2008 to a similar historical period.
And by studying those past patterns, we can potentially gain insights into future market movements.
That's the idea. But using analogs effectively requires a lot of skill and experience.
It sounds like there's always more to learn in the world of global macro trading.
There is. It's a continuous journey of learning and discovery.
And for those who are willing to put in the time and effort, the rewards can be substantial, both intellectually and financially.
Absolutely.
Hmm.
But it all starts with a solid foundation, and that's what Gliner's book provides.
So if you're interested in exploring the world of global macro trading, this book is an excellent place to start.
I agree. It's packed with valuable insights and practical tips.
All right, well, we've covered a lot of ground today, and I feel like I've learned a ton. Thanks for sharing your expertise with us.
My pleasure. It's been a great conversation.
It has. I'm really looking forward to diving deeper into Gliner's book and exploring those Bloomberg shortcuts he mentions.
Those shortcuts are a real game changer, trust me. They'll save you a ton of time and effort.
I can't wait to check them out. And I'm also curious to hear more about the specific strategies and techniques that Gliner discusses in the book.
Oh, we'll definitely be getting into those in our next episode.
Sounds good. So join us next time as we continue our deep dive into global macro trading, profiting in a new world economy.
It's going to be a fascinating ride, so don't miss it.
See you next time. We've been unpacking a ton of information from Gliner's book, but those Bloomberg shortcuts he mentions sound incredibly useful.
Oh, they are. Like having a secret decoder ring for the Bloomberg terminal.
Okay, I'm intrigued. Give me some examples.
All right, so let's say you're interested in, specific countries' sovereign debt.
Okay.
Gliner gives you shortcuts to access crucial data, like their debt levels, GDP figures.
So you can quickly evaluate a country's fiscal health?
Exactly.
Yeah.
And it's not just sovereign debt. There are shortcuts for analyzing equities, too.
Oh, really?
Yeah, you can access things like price to book, price to earnings, dividend yield, even shortcuts for analyzing stock market capitalization as a percentage of GDP.
Why would that be important?
Well, that could be a helpful indicator for spotting potential asset bubbles.
Oh, I see. So if a country's stock market gets too big relative to its economy, that could be a warning sign.
Exactly. And Gliner doesn't stop there. He provides shortcuts for fixed income markets as well.
Really? Like what?
You can quickly get data on yield curves,
Yeah.
credit default swaps.
It's like having a whole research department at your fingertips.
It is. But don't worry about remembering all these shortcuts. Gliner has you covered.
Okay, good.
He's organized them neatly by chapter, and each shortcut comes with an explanation.
That's reassuring. So mastering these shortcuts could give traders a real edge in the market.
Oh, absolutely. In fact, Gliner even encourages readers to create their own custom shortcuts.
Oh, that's cool. So you can tailor them to your specific trading needs.
Exactly. But even with best tools, we can't forget about risk management.
That's right. It's easy to get caught up in the excitement of a potential trade and forget about the downside.
That's why Gliner talks about things like stop-loss orders.
Stop-loss orders?
Yeah, it's a way to automatically sell a security when it hits a certain price, to limit your losses.
So it's like a safety net.
Exactly. And he also covers position sizing, which is determining how much capital to put into each trade.
So it's not just about what to trade, but how much to trade as well.
Right. Because managing your position size carefully can prevent a single bad trade from wiping out your entire portfolio.
This makes a lot of sense. It's not just about chasing profits. It's about managing risk, being disciplined.
Absolutely.
Yeah.
And Gliner points out that psychology plays a big role in all of this.
Oh, yeah. We talked about biases earlier, but are there any other psychological pitfalls that traders should be aware of?
Well, one big one is FOMO, the fear of missing out.
Oh, yeah. I know that feeling.
It can lead to some really impulsive and often disastrous trading decisions.
So how do we avoid that trap?
Gliner's advice: stick to your plan, focus on your own goals, don't get swept up in the hype.
Tune out the noise and play your own game, right?
Right. And another trap is overconfidence. You have a few winning trades, and suddenly you feel invincible.
And that's when you're most likely to make a mistake.
Exactly. So it's important to stay humble and remember that everyone makes mistakes.
This has been a really helpful discussion. I feel like I'm starting to understand the importance of risk management and psychology and trading.
They're essential. And Gliner's book does a great job of explaining all of this.
It really does. So, to all our listeners out there, if you're serious about global macro trading, definitely check out Kleiner's book.
I second that. It's a great resource, and those Bloomberg shortcuts are invaluable.
All right, well, we've covered a lot of ground today, but there's still so much more to explore.
There is. In our next episode, we'll dive into some specific strategies and techniques that Gliner outlines in his book.
Sounds good. I can't wait. So, join us next time as we wrap up our deep dive into global macro trading. It's really amazing to think about how all those global economic forces can impact our everyday lives.
It really is.
We've talked about technical analysis and data, but Gliner emphasizes that you need more than that.
Oh, absolutely. Successful global macro trading also requires a deep understanding of, the economic principles and concepts.
Right, so it's not enough to just read a chart. You got to understand the economic forces driving those chart patterns.
Exactly. Think of it this way. Technical analysis is like the art of reading the market's language.
Okay.
But economic analysis,
Yeah.
that gives you the context, the meaning behind those signals.
Ah,
It's like learning the grammar and vocabulary of a language before you try to read a novel.
So what are some of the key economic principles that Gliner highlights for global macro traders?
Well, he spends a lot of time discussing the economic cycle, how economies tend to move through periods of expansion and contraction.
Oh, right, right. So understanding where we are in that cycle can give us clues about potential market movements.
Exactly. Like, if you believe the economy is headed into a recession,
Okay.
you might adjust your trading strategy to focus on assets that typically perform well during downturns.
So like government bonds or gold.
Right. He also digs into the concept of inflation.
Inflation. Yeah, that's a big one these days.
It is, and it could have a huge impact on interest rates, exchange rates, asset prices.
So understanding how inflation is trending is critical for global macro traders.
Absolutely.
Yeah.
And then there's interest rates, the cost of borrowing money.
Right.
Central banks play a big role in setting interest rates, and their decisions can ripple through global markets.
Can you give me an example of how a change in interest rates might impact a trader's strategy?
Sure. Let's say you're a trader who believes the Fed is going to raise interest rates soon. Knowing that, you might decide to sell bonds because bond prices tend to fall when interest rates go up.
It's like a game of chess. You got to anticipate the moves and position yourself accordingly.
Exactly. And Gliner also talks about the importance of understanding exchange rates.
Right, right. Exchange rates determine the value of one currency relative to another.
And they can fluctuate based on a bunch of factors. Interest rate differentials, economic growth, even political stability.
So global macro traders need to pay close attention to those currency movements.
They do. It can really make a difference in their overall returns.
It's amazing to see how all these pieces fit together. But with so much to keep track of, it must be hard to stay focused.
It can be. That's why Gliner emphasizes the importance of having a clear trading plan, a set of rules to guide your decision-making.
So it's not enough to just have a hunch. You need a well-defined strategy.
Right. You should think about your investment goals, your risk tolerance, your time horizon before entering any trade.
And your trading plan should outline things like your entry and exit points, your risk management strategy.
Exactly. Having that plan in place can really help you stay disciplined, avoid making emotional decisions.
So it's like having a roadmap to navigate those choppy market waters.
I like that analogy. But of course, even with the best plan, you can't predict everything.
Right. Unexpected events can always pop up.
That's why Gliner suggests staying informed. Monitor global events, watch for economic data releases.
So you got to be adaptable, ready to adjust your strategy as needed.
Exactly. Global macro trading is dynamic, constantly evolving, and successful traders are the ones who can adapt.
This deep dive has been incredibly insightful. We've covered so much ground, from understanding the basics to exploring those complex strategies.
And we talked about psychology, the importance of discipline, emotional control.
It really is a fascinating field, and I feel like I've gained a whole new appreciation for it.
Gliner's book provides a great framework for anyone who wants to learn more.
It does. But as we've said, the real learning comes from applying those concepts, developing your own style, and never stop refining your skills.
It's an ongoing journey, for sure.
And for those who are up for the challenge, global macro trading can be incredibly rewarding. It's a chance to understand the forces that shape our world and potentially even profit from those insights.
Well said.
And on that note, we'll wrap up our deep dive into global macro trading. Thanks for joining us.